Okay, so I'll start again because I'll put this in a YouTube also. So if you have any doubt later on, so you can check it. Okay, so it's, you can say double type. We are going explanation. Okay, so today we are going to start with the cash flow statement, and in the cash flow statement we are going to consider only inflow and outflow of cash, means whether the cash is coming in or cash is going out. We are just going to think about the flow of a cash. So while studying this, we have three activities. First one is operating activity, investing activity, and financing activity. Operating activity is the biggest part of the cash flow statement because we have four subparts in the operating activity. So which are the four subparts? First one, net profit before tax. See, this is the net profit before tax. Second one, non-operating item. Third one is working capital changes. And the fourth one is income tax paid. So these are the four parts we have for a operating activity. So in these four parts, there are certain line items comes that also we are going to discuss. But before that, I want to tell you here we are just going to think about flow of cash, whether the cash is coming in or going out. Because see, when we are doing accountancy, our mindset is what? Asset increase is a good thing for us, right? Asset increase is a good thing for us. But in the cash flow statement, it is a negative. Why? What is the reason? What is the logic? Why it is negative? Any logic you know why asset increase is negative in the cash flow statement?
So because money is going out.
Because you are buying that fixed asset, right, Tanisha? When you are buying that fixed asset, it means that money is going out. That's why it's a negative in the cash flow statement. So when you are doing a cash flow statement, we have a separate rules for a cash flow statement. So what is our mindset is what expenses are positive, incomes are negative, assets increase is good, asset decrease is bad, and all that we used to do in the revaluations, right? But here we have a separate rules for a sign and separate rule for every activity, every part of the activity. That rule also I mentioned in this document. Okay, if you see down, rules also I mentioned over here. See, rules for sign. These are the rules for the sign. How we are going to decide the sign. That also it is mentioned in this document. Okay, so I'll explain you one by one everything. First of all, in the operating, what is operating means? To operate the business, what business incurred, what is business spent, and what business earned. That we are going to calculate in the operating. Under that, we have four subparts. First one is what? Net profit before tax. That is a working note number one. Net profit before tax, we always calculate in the working note, and then we final balance we record over here. So under that working note, what comes? See, this is the working note. Under the working note, net profit before tax, there are total 5 items. First is difference between P&L account. Second is difference between general reserves. Now, why I'm saying difference? Because if you see the cash flow statement sum, they will provide you 2 years balance sheet. They will provide you what? 2 years balance sheet, current year and previous year. Let's take an example, 23, March 23 and March 22. So when they provide 2 years balance sheet, we have to take difference between 23 and 22. For example, previous year the profit was given 80,000, current year profit is given 1 lakh. So 80 and 1 lakh. What is the difference between these two is 20,000. That 20,000 we are going to consider here. Difference between P&L account. Okay. Then difference between general reserve as well, similar way. Then current year tax and previous year. Tax also they will provide you previous year and current year. So from there we take current year tax, but dividend we take previous year. And interim dividend. What is interim dividend means? Half yearly dividend. What is it? Half yearly. Because company generally make the dividend payment on the last day of the financial year, but some companies give dividend during the year also. So when companies giving the dividend during the year, it's called as a interim dividend. Clear? So when you consider these 5 items, we'll get the net profit before tax. Now we'll discuss the rules of this particular working note. Check what is the rules for sign for this working note. All items are positive except losses. All these 5 items generally put positive, but sometimes A part it can be negative. But B, C, D, E, it cannot be negative. Never. Only A can be positive and negative. In case of profit, it is positive. In case of loss, it is negative. Rest all B, C, D, E is always positive. That I mentioned over there. All items are positive except losses. If the balance sheet, one more important point. The balance sheet, one item is positive and one is negative, then we add both of them and we give current year sign. This is a basic maths. I'll tell you, previous year it was 20,000 negative and current year it is 50,000 positive. So what is the exact change from the previous year to this year? Is 70,000 positive, right? Because minus become plus. This you'll understand while doing the sum. But just keep in mind that when we are taking the difference and both your signs are different, then we'll add them instead of subtracting and we'll give the current year sign for that. Clear? Okay. Now, after non-operating, after the net profit before tax, we have a second is a non-operating item. Non-operating. Some people call it as a non-cash. Some people call for this is non-cash. So what is non-cash or non-operating item means? Actually, these items doesn't have an impact on a cash flow statement. But we already included that while calculating the net profit. Because we are taking the difference between profit means what? All these items generally we take. Do you remember when we used to do the final account, we used to consider depreciation, we used to consider dividend, we used to consider profit or loss on sale of machinery or investment, interest received, share issue expenses, discount, goodwill, bad debts. All these expenses we used to consider while calculating profit. So when they calculate the profit, they have considered this. But we do not want the effects of the non-operating in a cash flow statement because these are what generally a non-business related expenses. That's why we are going to exclude that. So now tell me one thing, logically speaking, if I calculate the profit considering these items, so depreciation, what I did, I subtracted, right, to get the profit. So if I want to exclude that, what I'll do now, I'll add back. Similarly, interest paid while calculating the profit, generally we subtract when we used to calculate the profit. So here we add back because we do not want the effect of these items. That's why we add back. Now, profit or dividend receipt. Dividend receipt is an income. So generally while calculating the profit, we add this in the profit. But here what we do? We'll subtract. That's why the rule of non-operating item is, if you see the rule of non-operating item is what, see. What are the rules of a non-operating? All expenses and losses are positive and all incomes and gains are negative. All expenses and losses are positive and all incomes and gains are negative. Okay. Now, third one. Working capital. Okay. So the third part is what the cash flow statement is a working capital changes. Working capital changes, we have considered two things. First one is what? Current assets, and second one is a current liability. But while putting all current assets, there are some exceptions. Now, what are the exceptions? Except cash, bank, and marketable securities. These three things we exclude while recording all current assets in the working capital. Similarly, in the current liability also there are some exceptions. We record all current liabilities over here except short-term borrowings. So what is short-term borrowings? What we used to record in the short-term borrowing? What we used to record in the short-term borrowing? Schedule 3, bank overdraft, cash credit, working capital loan, right? These are what? Short-term borrowings that we exclude, and short-term provision as well. So what we used to record in the short-term provision for tax, that also we exclude, correct? So while recording here assets and current assets and current liabilities, there are some exceptions. So these are the exceptions. Okay. So we exclude means what? We are not going to ignore that. We exclude from here, but we record somewhere else, right? So where we are going to record that we'll discuss later on. But we exclude from the working capital changes. Is it clear? Okay. Now, after that, we have a fourth part is the income tax paid. So this is what, this is a previous year. This is what? Previous. You remember the working capital, working note, we added the tax current year over there. So previous year we write here. And always negative. Always negative. We forgot to discuss the rule of the working capital. We'll discuss the rule of the working capital as well. Working capital. Rules for the working capital. If assets increase, then negative. What is the rule? What is the logic? Asset increase. We just discussed that. Suppose last year inventory was 50,000 and current year inventory is 80,000. What does it mean? Why it is increased? Because you bought the inventory, correct? So when you bought the inventory, when you are buying the inventory, the flow of cash is what? Out, right? That's why it's negative. If current asset decrease, then positive. Take same example, other way around now. Last year inventory was 80,000 and current year it is showing 30,000. So why inventory decreased 80 to 30? Because we sold the inventory. So when we sold the inventory, the flow of cash is what? In, right? It's coming in. That's why it's a positive. Correct? Next. If liability increase, then positive. The logic is what? Suppose last year your trade payable is 30,000 and current year it is 50,000. So you borrowed more money. That's why it's positive. Current liability decrease, then negative. Let's take an example. If your outstanding expenses previous year was 5,000 and current year is 1,000. Why it is decreased by 4,000? Because you paid them. So when you paid them, it's an outflow of cash. Correct? So that's why these are the rules. It's ulta against. Generally, asset increase is a good sign for us, and asset decrease is a bad sign for us. But the cash flow statement, it's ulta, other way around. Current asset increase is negative and current asset decrease is positive. Okay. Now, fourth is income tax paid that we always discussed, and that is always negative. Then investing activity. Investing, the word itself self-explanatory. What is investing means? What you invest in the business. What you invest in the business, right? So generally when you want to do a business, what investment you do? First of all, to buying a land or for factory, and then you're buying started buying the machinery for a factory, equipment for a factory. So basically you start buying the assets. That is called as an investment you are making for a company, correct? Similarly, we are buying investments. Suppose we got some surplus money. We'll start buying the other company shares. That is called as buying of investment. So basically, investing activity deal with the fixed assets. Generally deal with the fixed asset. What are the changes happen in the fixed asset? That we are going to record in the investing activity. So what kind of changes in the fixed asset? Either we'll buy the fixed asset, or we sell the fixed asset, right? Or we'll receive interest from investment, we receive dividend from investment, we receive rent from a property held as an investment, or we can say intangible asset also we consider in the investing activity, because PPE, under PPA there are two things coming, tangible and intangible. But tangible ka buying and selling both we record in the investing, but intangible ka we are recording only buying. Selling is not possible as per the cash flow statement. selling of intangible not possible. As per the cash flow statement, that's why selling of intangible asset, we are not going to record in the investing activity. As per the cash flows rule, they are saying intangible asset cannot be sold. That's why it's not going to be considered. Now, the question is in your mind, what if the intangible asset decrease? For example, goodwill, last year it was 15,000 and current year it is 10,000. Last year 15, current year 10,000. It is decreased by 5,000. So where we are going to record that? If you are not going to record in the investing activity. See, if you see the non-operating item, it's called as a amortization. What is amortization means? It is a depreciation of intangible asset. So intangible asset decrease means it's called as it's a depreciation only, but there's a technical word, specific word given in accountancy. So the intangible asset is called as amortization. Clear? So buying of assets, selling of assets, purchase of investment, sale of investment, interest received, dividend received. So now interest received, dividend received, and rent received, why it is a part of investing activity? Because interest we received on what? What we put FD in a bank, that is the investment. Or dividend we received on what? When we buy shares of other company, we'll get a dividend. So all these are connected. So interest received, dividend received is an investment only. That's why it's a part of investing activity. And rent received also, because I clearly mentioned property held as investment. And then the purchase of intangible asset. Clear? So this is the investing activity. Now we'll discuss the rule of investing activity. Same rule will apply. See, same rule. Investing and financing, same rule. If asset increase negative, asset decrease positive. Asset increase negative, asset decrease positive. Same rule, same logic. Buying a machinery, outflow of cash. Selling a machinery, inflow of cash. Right? Same logic we apply for the investing and financing. Okay? So asset increase negative, asset decrease positive, liability increase positive, liability decrease negative. Clear?
Yes, sir.
Financing activity. This word is also again a self-explanatory word. Financing. Now, generally, when you run a company, public company, joint stock company, who are the financer of a company? First financer of a company is shareholder. Correct? Who's the first financial? Shareholder. That's why changes in share capital comes in the financing. Second financer of a company is borrowings, bank loans, public deposit, fixed deposit accepted, right? Capital expenditure loan, long-term borrowings, any kind of a borrowings. They are financiers for the company. So that comes in the financing activity. Third one is the changes of short-term borrowing. Do you remember in the working capital I excluded the short-term borrowing? So exclude from there and record over here. Because borrowing is a part of financing activity. So all borrowing, whether it is short-term or long-term, doesn't matter. Both will come under financing activity. Why? Because they are the financer of our company. They are financing, they are lending their money to us. That's why it's a financing activity. So what I'm telling you this again and again, because if you know what exactly financing activity is about, then it'll be easier to classify the items under operating investing. Right? So financing what? Those who are financing the company, changes in their balances will come in the financing activity. Okay. Now your share issue expenses paid while issuing shares, we spend some money that we are going to record over here. Discount on issue of debentures, it's related to debentures. Debentures is a long-term borrowing. That's why it's a part of financing activity. Security premium will get on the shares only. So that's a part of financing. That's why security premium also part of financing. Interest paid, we paid on borrowings. So related, that's why financing activity. Dividend paid on, we are paid on share capital. So that is also connected to the financing activity. Premium on redemption. What is premium on redemption? Debenture chapters we have done. That time we pay some extra money while redeeming the debentures. That time when we are paying extra money, that is also part of financing activity because it's connected to debentures. Correct? So these are the generally appear in the cash flow statement. There are n number of items, but if you see the sums, these are the generally appeared in the balance sheet or in the cash flow statement. That's why I made just only 9. Investing also 8. And operating also these 7, 8 non-operating items. So these are the what most common. Generally, it comes in this. Financing activity rule is also same. Asset increase negative, asset decrease positive. So you can say from working capital changes, we are going to follow the same rule. Only for non-operating is a separate rule, and for net profit is a separate rule. But working capital, investing, and financing is the same rule. Asset increase negative, asset decrease positive. Okay, I hope everyone understood the cash flow statement rules and the basic fundamental of the cash. Before starting any sum, we need to make this format be easier for us. If you do like this way, it will save your time, and there are very less chances to miss any item when you have a format ready in front of you. Okay, so how do I start? They said from the following summarized balance sheet of a company, calculate the cash flow from operating activity. They're asking only operating, but I'm showing you the all three activities. Okay. Equity share capital, sorry, equity and liability under that shareholders fund under that share capital. If you see the share capital, previous year it was 1,60,000. How much it is? 1,60,000. And current it is 2 lakh. Right? So what is the difference between these two? 1,60,000 and 2 lakh is 40,000. So it is increased by 40,000. Okay. So share capital is which activity we are going to record share capital? Just discuss financing activity, correct? So I'm going to record that share capital in the financing activity. I'll write here share capital 40,000. And the rule of a cash flow statement says when liability increases positive. So here I'm keeping it positive. After that, we have reserves and surplus. Last year, reserve surplus was 40,000 and current year it is 60,000. Reserve surplus. Reserve surplus generally consists what? Generally consists statement of P&L and general reserve, correct? That both items comes in net profit before tax in the working note. So that working note I'm making over here. Working note number 1. So statement of P&L. Because there's no breakup given, so I'm considering that is a statement of P&L. What is the difference? 60-40. Difference is 20,000. And since it is increasing, it's positive because profit is increasing. It's a positive, correct? So this is done. Now non-current liabilities. Under that we have given long-term borrowings. Borrowing is a which part activity? Borrowing is a financing, right? Because they are finances for us. It was 1 lakh, 1 lakh. Leave it. No flow of cash. It was 1 lakh, 1 lakh. There is no flow. Leave it. We don't do anything with it. Next, trade payable, current liability. Current liability comes under working capital changes, and under that we have given us a trade payable. So trade payable we are not going to exclude from the working capital because we are going to exclude only two things: short-term borrowings and short-term provision. But trade payable is not a short-term borrowings and not a short-term provision as well. So we're going to consider in the working capital changes. Check the trade payable. It was 75,000 and it's 79,000. It increased by 4,000. Okay. So current liability increase is positive or negative? Liability increase is always positive. So we'll put in the add. See, that's why I made here add and less. So positive ones I put in the add. Okay. It's 4,000. Correct? Now, other current liability. This is also not short-term provision or short-term borrowing. This can come in the working capital. It was 10,000 and become 26,000. Increase by 16,000. Again, current liability increase. That I'll write in the working capital add over section. OCL, other current liability. 16,000 positive. Because liability increase. So liability side is completed. Right? Now asset side. Non-current asset. Under that we have a fixed asset. Fixed asset is a part of which activity? Is an investing activity. Correct? So see, it was 2 lakh and then it become 2 lakh 80. It increased by 80,000. So when the fixed asset increase, when we buy the fixed asset. Correct? So when we are buying the fixed asset, investing activity, I'll write here purchase of fixed asset. 80,000 is the difference. And when we bought the fixed asset, the flow of cash is out, right? The money is going out. So it will be negative. Correct? Next, non-current investment. Non-current investment also part of investing activity. It was 60 and become 68. Increased by 8,000. Again, it is a purchase of investment. Purchase of investment. 8,000 negative because again it's an outflow of cash because we are buying the investment. The flow of cash is going out. Next, we have current assets. Current assets comes under working capital changes. So there are some exceptions. Okay, first we'll check inventory. We do not exclude, we record in the working capital. Because what we exclude from the current asset is only three things: cash, bank, and marketable securities. Okay, so inventory we record. See, it was 14 and become 35. It is decreased by 5,000. So inventory decrease. The flow of cash is what? In, right? Because when inventory is decreasing means we are selling the inventory. So the flow of cash is in flow. That's why it's add. Positive 5%. Then we have a trade receivable. It was 50 and become 54. It means current asset increase. Current asset increase is always negative. So that I'll write in the less. Trade receivable. Difference is 4,000. Negative. Right? Cash we consider at the end of a cash flow statement always. So now we'll start closing it. How do we close? First, we close the working note. Nothing else is there, only 20,000. That I'll write here. Okay, non-operating, we don't have any item. Okay, so first we'll add these two. So there's nothing on the non-operating, so it's 20,000. This 20,000 is called as operating profit. What it called? Operating profit. In this operating profit, what we'll do? We'll add these first three because that these are in the add. This will subtract. Okay. 20,000 plus 4 plus 16, 40, 45. 45 minus 4, 41. I'll just check on calculator also once. 20 plus 4,000 plus 16,000 plus 5,000 minus 41,000. So this 41,000 is called as cash generated in operating activity. And from this cash from operating activity, I'll subtract the income tax paid. Then I'll get the final figure. In this sum, there is no income tax. That's why I'm not subtracting. So this is the final total of the operating activity. For this, we'll write cash from operating activity. Final total of the operating activity. Similarly, I'll close the investing. These are the two in the investing activity, 80 and 8, 88,000 negative. Okay, so this is 88,000 negative for investing. So I'll write here cash used in investing activity. So see, in the operating, I use the, actually I put the word is from, and here I put the word is used. Why like that? Because operating is a positive answer and investing is a negative answer. So if it is positive, we use from, and if it is negative, we write used. Financing activity else we close 40,000. There's only one thing that I'll put it out. Financing activity total. This is from, because the answer is positive. Financing activity. Clear? Now, we need to add these three. This is operating activity total, this is investing activity total, and this is financing activity total. So we'll add these three. So 41,000 minus 88,000 because it was negative, and plus 40,000. The final answer is 7,000. Negative. This 7,000 is called as net change in cash. Net change in cash. Correct? So this net change in cash, how do we going to check this cash flow statement whether everything is we recorded correctly and we got the answer correctly or no? How we used to check with the balance sheet. If balance sheet match means everything is correct. If the balance sheet is not matching means everything is wrong. Means something is wrong. So similarly in the cash flow also we have one thing to check it. How we are going to check that? In this net change, I'll add the opening cash. And the answer of these two should match with the closing cash. Okay. So what is the opening cash? Opening means previous year cash. See, what is the previous year cash? Is 35,000. Previous year cash is 35,000. So I'll add that 35,000. So 7,000 negative and 35,000 positive is 28,000 positive. And it's matching with the closing cash 28,000. That's it from the cash flow statement. I hope everyone understood about this cash flow statement, how to deal with the cash flow statement.